Good morning, everyone. In today's session, we will be doing a problem from the exam kit, the Corfe company. So let's jump right in. Corfe company produces batteries and has developed a battery whose selling price is $45. Production capacity is 262,500 units. So that's the maximum production capacity. Annual flexible budget is. Now, what do you mean by flexible budget? It's nothing but a budget where the variable expenses and the fixed expenses are given separately so that it is very easy to modify the budget. Now, in this particular case, they have given a flexible budget for 185,000 units. They have modified it into a budget for 200,000 units. They have again modified it to 225,000 units. Even we can modify it. We can create a budget for 262,500 units as well, simply because the raw material cost and labor cost, which are variable cost, and the fixed expenses are given separately. Okay. Additionally, for each increment of 50,000 units, one supervisor is needed. What does it mean? For every 50,000 units, one supervisor is required. A supervisor's annual salary is $35,000. Now, since they have mentioned the word additionally, it simply means that the supervisor's salary is not included in this table above. Now, what is the first part of the question? What is the flexed production cost if the production is 80% of capacity? So we have to just create a budget for 80% of capacity. Now the maximum production capacity is 262,500 units. That's 100%. So 80% of that is 210,000 units. So the first part of the question is, we have to create a budget for 210,000 units. Now, in order to create a budget for 210,000 units, we should first know what is the variable cost per unit. So the first item, material cost, it's anyway variable. So what is the material cost per unit? It is quite simple because for 185,000, the material cost is $740,000. So material cost per unit is $740,000 divided by 185,000 units, or it is $4 per unit. Now you could choose any column. That is, raw material cost per unit is also $800,000 divided by 200,000 units, which will give you the very same answer of $4 per unit. Or it is $900,000 divided by 225,000 units, which again gives the very same answer of $4 per unit. So what did we just see? The material cost per unit is remaining constant at $4 per unit for all the activity levels. So in order to find out whether a particular cost is a variable cost, all that we have to do is find out the cost per unit, and if it remains same for all the activity levels, then it is a variable cost. Now coming to the labor cost per unit. So for 185,000 units, the labor cost in dollar is $1,017,500. So what is the labor cost per unit? Labor cost per unit is $1,017,500 divided by 185,000 units, which gives an amount of $5.5 per unit. Now, in this case, we have assumed that labor cost is a variable expense. Now, just to be doubly sure, I want you to cross-check this figure of $5.5 from the second column as well. So what is the labor cost per unit? It is $1,100 divided by 200 units. So what do you get? You get the very same answer of $5.5 per unit. This is just as a cross-check because in case labor cost is a semi-variable cost, that is, a portion of the labor cost is fixed and a portion of the labor cost is variable. So just to be doubly sure that labor cost is purely variable in this particular question, I request you to cross-check your figure from two activity levels. Okay, now coming to fixed cost. Fixed cost is remaining constant for all the activity levels, that is for 185,000 units, 200,000 units, and 225,000 units. What does it mean? It simply means that the company is following marginal costing system. If they were following absorption costing system, they would have flexed the fixed cost also. If you recollect what I said in part 1 of the budgeting video, I said that you have to flex the fixed cost if absorption costing is followed. But if marginal costing is followed, you don't need to flex the fixed cost. In this particular example, they have not flexed the fixed cost, which means that they are following the marginal costing system. So we can very safely take fixed cost as $750,000 for 210,000 units as well, because in marginal costing system, we do not flex the fixed cost. Okay. And any doubts regarding this concept, please check my part 1 video on budgets. Now coming to the next expense, that is the supervisor's salary. Now for 50,000 units, we need one supervisor. So for 210,000 units, how many supervisors do we need? It is 210,000 divided by 50,000 or 4.2 supervisors. Since we cannot cut a supervisor, we obviously have to recruit 5 supervisors. So 5 supervisors' salary will be, each supervisor is paid how much? $35,000. So the total is $35,000 into 5 or $175,000. Now we have got all the information to prepare the budget for 210,000 units. So let's get started with preparation of the budgets. Now I have just copied the details that we have already found out for your easy reference. Now, the preparation of the budget. So this is the budget for 210,000 units. We are supposed to key in all these information. Now, first item is material cost. 1 unit, it's $4. So 210,000 units, it is 210,000 into 4 or $840,000. Now coming to the labor cost, 1 unit, it's $5.5. So for 210,000 units, it is 210,000 into 5.5 or 1,155,000. Now coming to fixed cost is constant for marginal costing. So we write the very same figure of $750,000. So fixed cost is $750,000 and supervisor's salary, that is also fixed at $175,000. So we write the very same figure. So we total it and we get the amount as $2,920,000. Now going to the second part. Machine maintenance cost should also be included in the flexible budget. Every 1,000 units will take 14 hours to produce. The annual machine hours and maintenance cost for the machine for the last 4 years were. So you are given the machine time in hours and also the maintenance cost pertaining to those hours. Okay. What is the estimated maintenance cost if production of the battery is 80% of maximum capacity? So what is 80% of maximum capacity? That we found out that it is 210,000 units in the first subpart. Now, coming to the machinery maintenance cost. So let's have working note 2, machine hours required for 80% of capacity or for producing 210,000 units. In the question, it is given that every 1,000 units will take 14 hours. So what is the time taken for 1 unit? It is 14 divided by 1,000 or 0.014 hours. So for 210,000 units, what is the machine hours taken? It is 210,000 multiplied by 0.014 or 2,940 hours. So we have to find out the machinery maintenance cost for 2,940 hours. This is our task. Now what have they given here? They have given the maintenance cost for different activity levels. Now, activity levels can be given either in units or in hours. Okay. In this particular case, they have given the activity level in terms of hours. So what did I say in the first subpart? In order to find out whether a particular cost is a variable cost, all that we have to do is find out the cost per unit for all the activity levels. If it remains the same, it is a variable cost. So in this case, since the activity level is given in hours, we have to find out the cost per hour of the activity levels. If they are same, it means that this is a variable cost. So let's check the maintenance cost per hour for these activity levels. Okay. So maintenance cost per hour. So for the first activity level, that is in year 1, it is 850,000 divided by 5,000 hours. So it is 170 per hour. Now coming to the second activity level, that is 4,400 hours. What is the maintenance cost per hour? It is 735,000 divided by 4,400, which gives an amount of 167 per hour. It is not the same, which means that it is not a variable cost, but it is a semi-variable cost. That is, it is a combination of fixed cost plus variable cost. So now we are faced with two tasks. We have to find out the variable cost per hour. We don't know that. We have to find out the fixed cost also. So what is a method that we have studied to split the semi-variable cost into the variable cost and the fixed cost? It is the high-low method. Do you remember high-low method? Don't worry, even if you don't remember, I will give a quick explanation of what the high-low method is, okay? So first, let's just strike out the maintenance cost per hour that we just calculated because it is of no use to us because it is a semi-variable cost. Now coming to the high-low method. The high-low method is a method of splitting the semi-variable cost into the variable cost and the fixed cost. High means the highest activity level and low means the lowest activity level. So let's first identify what is the highest activity level. So activity level is given in machine time, that is in hours. So the highest activity level is 5,000 hours and the lowest activity level is 1,800 hours. Now, the maintenance cost pertaining to 5,000 hours is $850,000. That is a semi-variable cost, which means that it is variable cost plus fixed cost, correct? And here also 450,000, since it is a semi-variable cost, that is also variable cost plus fixed cost. Now listen to my question. There has been an increase from 1,800 to 5,000 hours. So what is the increase? It is 3,200 hours, correct? And maintenance cost jumped from 450,000 to $850,000. So what is the increase? It is $400,000, correct? So this $400,000 increase, is it because of variable cost or fixed cost? It is because of variable cost, simply because fixed cost will remain fixed. It will not change. So the jump of $400,000 is because of variable cost. And what was the jump in hours? It is 3,200 hours. So what is the variable cost per hour? It is $400,000 divided by 3,200 hours. So we can get the variable cost per hour by adopting the high-low method. So let's write that beautifully. So working note 3, variable maintenance cost per hour, maintenance cost change. The change is $400,000 between the highest and the lowest activity level. And as far as the hours is concerned, the change is 3,200 hours. So what is the maintenance cost per hour? It is change in maintenance cost, that is $400,000 divided by change in machine hours. So that is why I've written the formula change in maintenance cost divided by change in machine hours. So the variable cost per hour will be $400,000 divided by 3,200 hours, which is 125 per hour. So now we are faced with the difficulty of finding out the fixed cost. Now we know that 850,000 is variable cost plus fixed cost, correct? And we know that variable cost per hour is 125 per hour. So what is the total variable cost? It is 5,000 hours multiplied by 125. So we get the total variable cost. That is, we got the total variable cost. So what is the fixed cost? Variable cost plus fixed cost is 850,000. If we know what variable cost is, then the balancing figure is fixed cost, correct? So let's write that beautifully. Working note 4, fixed maintenance cost. Now, fixed cost plus variable cost is the total cost. Now, substituting in the highest activity level, that is 5,000 hours, we know that variable cost is 125 per hour multiplied by 5,000 hours. So it is fixed cost, that's the unknown, plus 5,000 multiplied by 125, which is equal to the total cost. Now the total cost is $850,000. So we solve the unknown, that is a fixed cost, which is $225,000. So now we have got both the information. What is a variable cost per hour? 125. What is a fixed cost? $225,000. Now can you find out the maintenance cost for 80% of maximum capacity, that is the 2,940 hours? Now it is easy because we know the breakup of variable cost and fixed cost. So the maintenance cost for 2,940 hours is equal to the variable cost plus the fixed cost. And what is variable cost? The variable cost for 1 hour is 125. So for 2,940 hours, it is 125 into 2,940, and fixed cost is $225,000. So we add it to get the total maintenance cost as 592,500. And since they have asked us to round off to the nearest $1,000, the final answer is 593,000. The next question is a theory question. So I want you to have a quick recap of what we studied in part 1 of budgets, because that's relevant for this particular question. So let's take a look. Now suppose you have a flexible budget for 100 units prepared at the beginning of the year. Now what is flexible budget? Flexible budget is a budget where the variable expenses and the fixed expenses are given separately. We have the sales figure and we have the various expenses, and then you get the profit. Now, suppose the profit is $4 per unit and the number of units that we are planning to produce and sell is 100 units. So what is the budgeted profit at the beginning of the year? It is $400. Now coming to the actual results. Suppose we were able to produce and sell only 40 units. So the items that come for the actual results are also the same. We have the sales and the expenses. And suppose the profit that we achieved is $300. Now, can we compare the flexible budget with the actual results? No, simply because the actual results are for 40 units and the flexible budget is for 100 units. So what can be done? We have to create a flexed budget. And what is a flexed budget? Flexed budget is a budget which is prepared for the actual production units. What is the actual production? It is 40 units. So we have to prepare a budget for 40 units to make a comparison with the actual results. So let's prepare the flexed budget. So this is the flex budget that we prepare for 40 units. So we have again the very same items, and now the profit will be only $160. How did I get $160? Because for 1 unit it is $4. So for 40 units it is 4 into 40 or $160. Now we can make a comparison between the actuals and the budgets. Now look at this. When we changed from the flexible budget to flexed budget, what did we remove? We removed the volume fluctuations. That is, from 100 units, we have changed to 40 units. So there was a drop of 60 units, correct? Wherein the profit reduced from $400 to $160. That is when you're eliminating the volume fluctuations. What is the variance that is getting removed? It is the sales volume variance. So the difference between the flexible budget and the flexed budget is nothing but the sales volume variance because the volume fluctuations have been removed. Now, focus on the sales part of the flexed budget and the actual results. Suppose the flexed budget sales amounts to $2,000. So what is the selling price? It is 40 into $50 per unit, correct? And the actual results is $4,000. So what is the actual selling price achieved? It is 40 into $100, correct? So the only difference between the flexed budget and the actuals as far as the sales is concerned is because of the selling price. And what is that variance called? It is known as the sales price variance. This is the only thing that you have to put in your mind for tackling the next question. The difference between the flexed budget and the actual results as far as the sales is concerned is the sales price variance. Let's tackle the third subpart of the question. In the first month of production of the new battery, actual sales were 18,000 units and sales revenue achieved was $702,000. So they're talking about the actual results. The budgeted sales in units were 17,300 unit. Since the budget is for 17,300 unit and the actual is for 18,000 units, we have to obviously construct a flexed budget to compare the actual results with the budgets. Now, the question is, based on this information, which of the following is true? When the budget is flexed, the sales variance will be. So the answer is what I explained right now. The difference between the flexed budget and actual results is only the sales price variance, simply because the sales volume variance have already been taken out. So the right answer is it will include only the sales price variance. If you see the other options here, they have said the sales volume variance will also be included, which is not true. Here also they have said sales volume variance. And in the last option, they have said sales mix and quantity variance. Sales mix and quantity variance is nothing but the breakup of sales volume variance. So that is also not correct. So the right answer is option C. Now coming to the fourth subpart, which is true relating to a flexible budget. Budget preparation is time consuming as splitting semi-variable cost may not be straightforward. Now, what do you mean by semi-variable cost? Those expenses which have a variable portion and a fixed portion. Now, suppose electricity charges. Electricity charges, you have a fixed electricity charges and you have a variable electricity charges. Now, this variable electricity charges, can you arrive at the variable electricity charges per unit? Is it possible? Or is it remaining constant? Because variable expenses, it remains constant per unit, right? Do you think electricity charges per unit is remaining constant? It is incurred for a certain number of units. So you cannot actually break it up. You cannot actually break up the electricity charges and say that, the variable cost per unit is so much. So there are many expenses where the split up of the semi-variable cost into the variable cost and the fixed cost may not be correct or appropriate. So this sentence is right. Second sentence, the range of output over which the assumptions about how costs behave could be difficult to determine. Now, fixed cost, we assume that it remains fixed over a relevant range. Say from 0 to 50,000 units, this is a fixed cost. There might be many situations where the fixed costs change. Suppose the fixed salaried people, they want a revision of pay, or a certain person resigns and a new person takes his place. He might be recruited at a lower salary or a higher salary, or maybe there is a machine breakdown and we have to buy a new machinery, wherein the maintenance cost will be completely different from the old machinery. So you cannot always say that the fixed cost will remain fixed for a particular relevant range. So this point is also right. Now coming to the third point, flexible budget gives managers more opportunity to include budgetary slack than a fixed budget. Now, what do you mean by budgetary slack? Budgetary slack is the deliberate underestimation of budgeted revenue or overestimation of budgeted expenses, which allows managers to get good performance appraisals.
What does this mean? What do you mean by underestimation of budgeted revenue? Now, suppose you are the sales manager. You know very well that you can achieve a sales of 100 units next year. But what you do is, when you include the sales figure in the budget, you will include only 80 units. So what is the advantage? When the actual results come next year, you will be achieving 100 units. So when a comparison is made with the budgets, you will be having an awesome performance appraisal. So for that reason, you always tend to underestimate the budgeted revenue. And for expenditure, it is just the reverse. You will overestimate the amount in the budget. Flexible budget gives managers more opportunity to include budgetary slack than a fixed budget. Now, what is the difference between fixed budget and flexible budget? The only difference is that fixed budget, there is a total amount of budgeted cost. But in flexible budget, you have to give a breakup. What is a variable cost to be budgeted and what is a fixed cost to be budgeted? So that's the only difference. So they're telling you, when you are giving a breakup of the variable cost and the fixed cost, you are getting more opportunity to include that budgetary slack. Do you think that is possible? No, there is lesser chance, because once you give the breakup of variable cost and fixed cost, you are giving additional detail. So there is a lesser chance to include budgetary slack. So this one is wrong. Now, coming to the fourth point, budget will encourage all activities and their value to the organization to be reviewed and assessed. Now, there is a budget called the zero-based budget. That is, for each and every expense and income, you review and analyze, and only then you include it in the budget. That is not a zero-based budget. So that is not a feature of flexible budget, which means that this point is also wrong, because this feature is a feature exclusively related to zero-based budget and not that of flexible budget, which means that these 2 points are right and the third and the fourth point are wrong. So the options that have been given are, okay, so the true statements are 1 and 2, which means that the right answer is option A. With this, we come to an end of today's session. I hope you've understood how the problem has been done. If you have any doubts, do post it in the comment box below. So thank you all and have a great day.